Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
One of the movers today is Salesforce.com. I thought it was just one of those stocks that can do no wrong, but the stock's down 20% this morning. Kind of reported some numbers a little disappointing to the street, so I want to break it down. And Alix, we can do that with Anurag from Chicago. Anurag Rana, he's a senior tech analyst for Bloomberg Intelligence. Anurag, Mark Benioff here. I thought everything he touches turns to gold. What happened to Salesforce and their results last night?
Yeah, the macro spending is not good right now, and we saw that with Workday a week ago. People are pushing out contracts or large deals. They're not signing at the same pace they did before. So a little bit of, tale of two tech stories. One is companies are spending more on AI, but then they're taking spending away from other areas, such as, buying new software or consulting and things like that.
Does Salesforce not have an AI product yet, and why?
No, they have one particular product called Data Cloud, and that grew 25%. But frankly speaking, remember, if you have a revenue base this size, of, $35-40 billion, that a few million is not going to move the needle if all the other spending starts to slow down.
All right, Alix, here's an example of just a great Wall Street inefficiency. One of the reasons that many firms on Wall Street just can't generate decent returns. There are 56 analysts covering Salesforce.com. I'm going to say
that's a lot. I'm thinking
5 get paid, 5 make a profit off of providing research on that name. Just absolutely crazy. 40 buys, 15 holds, 1 sell.
Oh my God, 40 buys?
Yep.
Oof.
So what's the 40 buys out there, Anurag? Did they fundamentally change their view of Salesforce.com after these results?
No. There's no reason to do that, because this is just elongation of the sales cycle. It's not that people aren't buying cloud products. It's just a matter of they're not signing large deals. People are basically saying, I can live with what I have right now, and I'll wait for next year to go back and buy this stuff. Things are not that horrible. I mean, they're still growing at 10% or so. It's not the end of the world. But what really happened is 3 quarters ago, their new bookings rate was slowing down and started to take a U-turn. So they went from 11% to 13%, and they were at 13% for 2 quarters in a row. This quarter, we were expecting it to be around 12% or so, 12 to 13%, and they came at 10. So these deals being pushed out, it's just a matter of time, whether it's 2 quarters away, whether it's 3, but they will close. People are looking to move more things to the cloud on the application side also. So it's just, I would say, a little bit of delay, but that delay now takes you into 2025 rather than being a middle of the, this year's story. So that's partially the reason people are saying, we'll come back to the story 6 months from now.
Are you surprised at the severity of the stock drop, though, based on this? Because this is also just the law of large numbers, right? You're growing at double digits, and then eventually that double digit slows. That's like life, right?
Yeah, Alix, absolutely right. I mean, if you look at Salesforce on the rosy side, their free cash flow this year is going to grow 20%, with the likelihood of another 15 to 20% growing next year. This company has now changed the narrative from high sales growth or growth at any cost to growing with a lot of margin expansion. This company has a long way to go before the margins reach, I would call maturity. They still 10 to 12% away from that stage. So there is a lot of free cash flow that needs to come out of this company. I think I am surprised about the severity of the reaction.
Anurag, I guess this kind of goes to a question I've been asking since this whole AI discussion began 18 months ago. How much of this is really incremental new spending for this new thing called AI versus just taking some tech spending from other parts of the stack, whether it's software, hardware, applications? And talk to us about that.
I completely agree with you. This has been our case because one of the things we saw was one of the most important companies in the space for leading indicators is Accenture. And their consulting revenue has been declining for the last 3 quarters because of exactly what you said. People are not If you have a consulting project, you put that on hold and you use that money to buy, GPU chips, new servers, trying to figure out if your infrastructure is ready for the next, phase of AI development. You're actually experimenting with new products and trying to figure out. And the big question for a lot of them is, do I really need to buy a brand new software product where my next generation CRM product could look a little bit different, or some other product could look a little bit different? What we are seeing right now is net tech spending flat from last year, no new increment, but we are hopeful that, the typical waterfall is you have hardware semiconductor spending first, then it trickles down to software, then it trickles down to services. So we are optimistic that next year we should see some improvement in software spending, and perhaps the second half of next year into the year after, something on the consulting and then the services side.
Do we learn anything from Dell in terms of AI and spend from Salesforce?
Yeah, but that's the same exact thing, that they are buying more AI servers, but at the expense of something perhaps like a Salesforce, or for that matter, Workday.
Okay, so a woe for Salesforce is good for Dell.
Yeah, it's good for all the semiconductor names and the GPU players. People are basically saying, okay, if I have to go experiment on AI, I got to find that money somewhere. Net, I'm still spending the same amount on technology that I did last year. It's a question of reallocation of those resources. Another place we're seeing an improvement in spending is companies outsourcing a lot more work, because that they are saying is, I got to find cost savings in order to deploy it into these AI products.
So just stepping back even further for tech spending, what are the likes of IDC saying about tech spending over the next, couple, 3 years, Anurag?
So the next 3 years, I think almost everybody unanimously believes that it is going to be a good number, because frankly speaking, and I've said this a number of times, when you look at it as a percentage of GDP, tech spending is still a small portion. When I look at just the US alone, we have somewhere around enterprise technology spending, excluding smartphones, somewhere around $1.5 trillion or so. When you look at healthcare spending, it's north of $4 trillion. So we talk a lot about tech, but as a percentage of total GDP in the US, it's still a small number. And software is even a smaller portion of that. So, I'm pretty optimistic to bullish that in the long run, I'm happy with the tech space in terms of growth rate, in terms of profitability, in terms of sustainability compared to other sectors.
What else is on your radar right now, Anurag, as we're almost done with all the big tech guys?
Yeah. So now when you look at it, Workday and Salesforce are the first companies to report in the next cycle of earnings. So when you look at results that are coming out in July, we're going to have a lot of the same of what we have heard from these two companies. Now, the two exceptions from that, in our view, could be Microsoft and perhaps even SAP. But other than that, every other tech, software company we anticipate, and even services companies, we anticipate will talk about the same thing: deal delays, elongation of that. And this is partially the reason, if you look at somebody like a ServiceNow is getting really hammered today, or Oracle getting hammered, and that makes sense, because this is a leading indicator that things are not going to be good when results come out in July.
Great stuff. Anurag's the best.
Yeah, of course.
Anurag, thanks a lot. Anurag Rana, Bloomberg Intelligence, a senior technology analyst. Salesforce just getting totally creamed. I mean, it's down like 20%. It's erasing like 370 points from the Dow.
Yeah.
This is a serious decliner here today.
And Mark Benioff, he's the, before today, he had a net worth of, according to Rich Gove, about $10 billion, taking a little bit of a hit.
A little bit of a hit there today.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Kohl's. Boy, the stock is down the most on record. Huge miss on earnings. Cut the guidance. And the street sending the stock down 27%, the most on record, just extraordinary. Let's check in with the Bloomberg Intelligence analyst that covers this stock in this sector. Mary Ross Gilbert, senior equity analyst for retail for Bloomberg Intelligence, is joining us from LA via Zoom. So, Mary, thanks so much for joining us here. 27% reduction in the stock price here. What does the market not like from the earnings?
Yeah, so we sort of knew going into earnings that they have a wonderful data measure that we use called Bloomberg Second Measure, and it basically tracks consumer transactions, ATM and credit card transactions. And so based on that data, we had a feeling that they might miss by 200 to 300 basis points, which they did. Comp sales fell 4.4%. That was below analysts' 1.7% estimate. And really what was happening there for the company is that they were going against a significant clearance activity in the first quarter of 23. Now, they knew that going into the quarter, and that's why they expected sales to be flat, but they expected their new category initiatives. This means like home decor, of course, Sephora, which continues to do really well. The key was Sephora bringing in all the customers and generating real sales and very profitable sales, is the fact that those customers are not buying enough of the adjacent categories. So that's where they sort of came up short. So they did show that their initiatives are working, but just not enough. And it's not across the whole store. And that's what they need to do. And so this is going to take some time for them to really get category mix throughout the store and really be executing. So it just delays this potential turnaround for the company.
Okay, so let me just break that down. So one, you got tough comps because it was really promotional last year. So that was stressful. But all the stuff that they're doing to entice people to buy stuff also isn't working in the way that they thought. Is that a consumer problem or is that a Kohl's execution problem?
Yeah, so actually I'm going to reword what you just said there.
Please.
Because it is working, those new categories. So for example, their home, seasonal, and everyday decor, those sales were up 30%. Impulse items were up 60%. Women's full price sales were up 3%, gifting up 30%. So we're seeing that they're working, but it's just not enough to offset, the weakness that they're experiencing, for example, in activewear. Even though they're private brands within active are doing well, they need to have a better mix of some national brands in there to really rejuvenate the sales in that category. Also, when they brought in Sephora shops, they got rid of jewelry. And so they sort of missed out on gifting in the jewelry area. So they're planning to bring that back. They're also hoping to boost conversion of those Sephora shoppers by bringing in more relevant junior brands. And that's going to come later this year. And that includes Aeropostale, Roxy, Madden Girl, Quicksilver, for example. And then, of course, they're going to be adding Babies R Us shops, which could also help them later in the year. So we do expect to see some improvement, and these categories are working. It's just going to take a lot longer to get the overall mix right. That's what we think is happening.
Mary, again, a 27% decline in the stock price on a piece of news like this, to me, it calls into question how investors are viewing this management team. I look on the MGMT function on the Bloomberg terminal, and I see most of the senior managers are only there less than a couple of years. So this is a relatively new management team. Is this Wall Street saying we don't have much confidence in you guys?
It could be temporary. That's the way I look at it, because frankly, Tom Kingsbury, who's the CEO here, he is the one responsible for turning Burlington stores into the successful, fast-growing off-price retailer that it is. It's very focused on the low-end consumer. So he, I think, is the right person, and all of the initiatives that he's been doing, we've noticed the changes dramatically since he came on board in the stores. In fact, even the culture of the environment, you go in there and you talk to the salespeople, year over year, once he came on board, we observed a huge change, a huge lift in the culture where everyone is more excited about the business. So, it's the first quarter. They had tough comparisons, and we'll have to see as more and more of these initiatives come into play. We think it's really just going to be a delay in the turnaround rather than, hey, this is a failure from management, because these things, when you're doing a complete redo of a business, it really takes time to gain traction, especially in an intense segment, which they play in.
We also get Nordstrom's, Gap, Costco out after the closing bell. That's a pretty random mix. It's going to be interesting to see the macro read for that. What are you going to be paying most attention to?
Well, lot of exciting things happening with Gap, and we're expecting to hear some positive results coming out of Gap. Nordstrom, I think they're seeing an improvement overall in the business, but most of it's being driven on the rack side. So again, that's their off-price model, and that's really sort of the big story for Nordstrom. But we think the full line store is seeing some improvement as well. And if you look at other retailers that are really executing well, like Abercrombie, which their numbers were out yesterday and just blew. Same with Urban Outfitters with their Free People and Anthropologie brands, once again, just blew past estimates. So it's really a case where if you're really executing, then you're coming out ahead of plan, and then of course the shares react accordingly.
So, Mary, what are you hearing from your companies, your contacts about the health of the consumer these days? What are we seeing?
It's a good question. I would say overall, the consumer is very resilient. So of course, within off-price or value, the low-end consumer is still being challenged with inflation. But the good news is they're employed. And so being employed, I think, is one of the biggest factors out there. And of course, we just saw. So that all bodes well for retail generally. But again, it's really going to be segmented with those earning a higher income being able to spend more, and those with lower income being even more discerning.
What I find so interesting, and you brought up Abercrombie, and we were talking to the Red Robin CEO also, if you know your customer, and I don't want to say niche because Gap isn't niche, but who you're designing for, and that's the business that you're doing, and you're not going to try and chase all the things, you can actually outperform in this market across the board, whether you're super high end, just take a look at LVMH, whether you're looking at Swiss watches, or whether you're looking at Gap, or whether you're looking, say, at Best Buy. And I find that to be a really striking difference maybe than what we've seen before.
Yeah, I would agree with you. So with Abercrombie, you raised a good point. Their sort of core millennial customer with the Abercrombie brand will continuing to introduce new categories. So for example, they brought out, the wedding shop, and that was sort of an add-on to the best dressed guest. And it was just so well received because they were listening to their customer, and they're giving them more and more of what that customer wants. And it's also extending the age range sort of beyond the millennial core consumer that they go after. And so that's also helping to bring in new customers, and then they're starting to look at the adjacent categories and buying there. So they're really showing how they can continue to execute against very difficult comparisons where they're already showing double-digit lifts in comp sales. So that's a sign of great execution right there.
All right, Mary, thanks so much for joining us. Mary Ross Gilbert, she's a senior equity analyst covering the retail space for Bloomberg Intelligence, joining us from Los Angeles via Zoom here. Looking at Kohl's again, that stock down 25% plus on some weak numbers.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in economics and finance through our lens of Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries all around the world. We're also taking a look here at some stocks really on the move after earnings, and one is Red Robin Gourmet Burgers. That stock is up a whopping 20%. You look inside the numbers, you're looking at adjusted loss per share at 80 cents, revenue down 7.1% year on year, comp sales down 6.5%, average check is a little higher by about 3%, and operating margin was 11%, but the street loves it. Let's get a read on why. GJ Hart is president, CEO, and director of Red Robin Gourmet Burgers, and he joins us now. GJ, great to get your perspective. What do you think the street is loving so much about these earnings when the numbers and the comps feel a little weak on the numbers?
Well, I think what they like is our strategic plan to move this company forward. We call it the North Star Plan, and And we reported that in the first 5 weeks of the second quarter that our comps had turned positive. And I think that surprised them a bit because I think they all had us slightly negative. And I think we're making great progress. Our teams have done amazing work, and we're really proud of where we are today. And we sequentially really improved in the first quarter in spite of a very tough start. So we feel great about where we're going, and I think they see that, and it's great to see.
GJ, talk to us about your consumer, your customer. Who is your customer, and kind of what are you seeing from your customers' behavior these days?
Sure. Well, our customer is basically middle America and families and all over the United States. And what we're seeing, interestingly enough, is in our premium burgers, in our premium gourmet burgers that we promote, we're seeing a real high take rate. We're also seeing that on the value end, the tavern burgers are actually having a high take rate as well. And so what we are seeing is some trade down from some of our guests, but then it's still surprising to see that our gourmet lines are still doing as well as they are. The other indicator is that things like add-ons, appetizers, desserts, those take rates are about the same. So net, we're feeling relatively good about the consumer.
When you take a look at who is coming through your doors, has that changed at all as the economic environment has become more challenging?
Well, put aside the economy for a minute. Our comeback plan and the North Star plan is all about engagement with our guests, bringing back fun, value, and really taking this iconic brand back to where it was. And so we're seeing a lot of lapsed guests come back in. We're seeing a lot of new guests. Our loyalty platform that we just relaunched, we're seeing numbers like we've never seen before in terms of signups. So we're getting a good base of people, and we're doing exactly what we wanted to do, is send a message, hey, come back into Red Robin, give us a try, and I think you'll be pleased. And we're seeing that. And so that feels great.
Inflation, how's that impact your business? To what extent can you pass it along to your customer base? How are you guys dealing with that?
So as we've said, inflation for us is sort of in that 3 to 5% for the year, and we're staying true to that. So certainly it's still there. In terms of pricing power, we've lagged others in the industry over the last couple of years, but we still feel like pricing is going to be tough, and we have a great value compared to pretty much everybody out there with a $17 check average in a full service experience. So again, we're positioned well. We are trying to screen value with our 30 bottomless sides and our tavern burger lineup. And I think that's starting to resonate with the guests that we're everyday value. And hey, you can come in and have a lot of fun at Red Robin.
What about labor?
Labor is always a challenge, right? Around the United States, we're seeing increases all over the place. But the good news is there's more labor available, so our team member base is strong at this point. And certainly it's a challenge. We have to be as efficient as possible. We've invested a lot back into the overall experience by putting labor back into the restaurants. Management teams are appropriate now. And so, yes, it's going to be an ongoing challenge, but we're not alone in that. And we're going to continue to stay the course because we believe long term it's the right thing to do for the brand to bring it back to the iconic brand that it's been for almost 50 years.
So, GJ, kind of on that front, give us a sense of the history of Red Robin. Kind of how did it get started? Where do you guys kind of find yourself in the competitive landscape, and where do you need to get to?
Sure. Well, Red Robin started up in the state of Washington, outside of Seattle, and it really started as a tavern. And its humble beginnings have gone to over 500 restaurants all over the United States. We have fit a really nice niche within casual dining. We are family friendly. We are a bunch of fun in the restaurant. We have great value, great hospitality, and great food. And that niche sort of has been one that when Red Robin really started to go a little bit astray, that no one's really filled that gap. So we really believe that positioning still holds true today. We just need to bring things relevant. So whether it's the food offerings or the hospitality or the fun environment, we need to bring it relevant, which is what we're doing, which is why we're investing so much into this plan. But if we do that well, we think there's plenty of room for us to continue to grow. And we're going to continue to work hard to make that happen.
And your resume is quite long, right? You're the former CEO of California Pizza Kitchen, Texas Roadhouse. I love KPC. No, CPK.
Well, if you're in Monterey, California, there ain't no pizza, and so CPK is it. So it's not bad. The kids are happy. It's all good.
No, it's good. And the barbecue chicken part of it was really good too.
Oh, you can't do that.
I do. I'm sorry. You've done a lot, and you've seen a lot, and you've operated these kind of restaurants through many different environments. Can you just give me your sort of career perspective on what you see now and trends developing and how things have changed?
Well, sure, I'd be happy to. Look, I think at the end of the day, in this restaurant business, you have to stay the course and really know who you are and who you're trying to be. And as long as you do that day in and day out, execute at a very high level, you're going to be successful. It's going to ebb and flow. The ups and downs are going to be there. And you need to stay true to who you want to be. And I think that's the big opportunity for us here. You know, in spite of a tougher economic backdrop, if you will, we're starting to see good success and great momentum for a plan that we put in place. So what I've seen over the years, you know, Texas Roadhouse, we grew. It was a real high growth company. Still love the company. CPK was a turnaround, and we had a lot of great success there as well. But again, you know, it's really staying true to who you are and making sure you align every single team member in the organization around your mission, vision, and values, where it is you want to get to. And so as long as you do that, stay the course, and you provide the leadership that's steadfast in that commitment, you'll be okay. And that's what my experience of almost 40 years now, gosh, getting old, but you know, that's what it tells me.
So, GJ, talk to us about the footprint for Red Robin. How many units do you have now? How many restaurants do you have now? And maybe where do you want to go?
Sure. Well, we have 510 restaurants. And, you know, look, at this point, we like to say, first things first, we need to get this North Star plan in place and start to have growth within our existing restaurant base. It's a little too early to talk about growth again. There is plenty of white space in America for more Red Robins, but we need to do first things first, and that's what we're doing. And, you know, it's a couple of years away in terms of thinking about growth again.
Really interesting stuff.
Yep.
When are you going to get them in New York? I've never been to one. Are you thinking about it?
Well, you're probably in Manhattan, right? So, no, we're not thinking about Manhattan right now, but we certainly would love to host you at any one of our restaurants.
All right, we'll go there. I know there's one. I know
the Summit. You said there's one in Summit.
Yeah, there's
right?
some in Jersey. We'll go there. We'll
field trip there. Then John Tucker's Beach Club.
Yep, of course.
Make the rounds. I think this all makes sense.
We'll drink on his tab.
GJ, thanks a lot. We really appreciate it. Really good perspective. Congrats on the good outlook and the stock pop today. Gerard Hart, President and CEO and Director of Red Robin Gourmet Burgers. I mean, you know, we've been eating out a lot more as the weather got nicer, and man, you see that on your credit card bill. So I can definitely see how sort of a different kind of place would be really helpful to go to and still be able to have fun and eat good food and also not pay $300 for 3 people.
Well, but you had a glass of Prosecco.
Yeah, but just one. I'm not like pounding him back like before. It's very different.
Where did you go that was $300 for 3 people?
Brooklyn.
Really?
Yeah.
Yes. Huh. And one of those 3 people is $9.50. So anyway.
It's 2.5 people.
I mean, yeah, exactly. 2.5 people.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
I'm Alix, alongside Paul Sweeney. Not only do we cover all the news and finance with our great analysts at Bloomberg Intelligence, we also tap our huge amount of reporters over at Bloomberg News. And every day they have a big take, and it really delves into the topics that we're talking about every day and does an amazing deep dive to get a true sense of what's going on out there. And today's big take is about none other than Elon Musk. And it talks about Elon's orbit, that Musk's galaxy of companies is basically under threat as Tesla continues to spiral, and it takes a look at the people in his orbit that try and keep things running, even though many accuse him of being distracted by all of his ventures. One of the writers is Kurt Wagner, Bloomberg Tech Reporter, and he joins us now. Kurt, just walk us through what you learned in this piece.
Yeah, I mean, a big part of what working for Elon is all about is sort of working for Elon everywhere he needs you, right? So you might be employed technically by Tesla, but you might show up on, a SpaceX project or an X project. And I think, not only are the people that he works with sort of hovering around in all of these various roles, but I think his companies are becoming closer and closer together. And that's why it's so important that, when Tesla is struggling, it has this trickle effect, because that's where he gets his wealth to fund XAI, to deal with X, to deal with SpaceX. And so, what we wanted to sort of do was show people that all of these different companies and all the people who work them are interconnected. And we try to do that with a pretty cool visual graphic that folks can see on the website today.
Kurt, what is the Muskonomy? Define that.
Yeah, it's a term that represents or reflects these 6 different businesses that he's running at any given time. And again, sort of this idea that they all work together. They in X's case, the data from X, which used to be called Twitter, is now sort of powering XAI, his startup, right? The money from Tesla has historically been used to help fund SpaceX and his purchase of X. And again, you see the Muskonomy as this collection of businesses that Elon runs and how they are all intertwined with one another.
Do the people in his orbit, do they like this? Like, that to me sounds terrible. Like, I like predictability, which I know is funny because I work in news. I like predictability. I like to know what I'm doing. I do not want to be pulled in 17,000 directions. Do people in his orbit like that?
Well, I think the people at the very, center of this universe, the people who are closest to Elon, whether they like it or not, it's sort of a necessity, right? Because that's what it takes to be close to that center of power. And so we've seen, for example, his business manager, Gerard Hart, shows up pretty much across all of these different companies. His lawyer, Alix shows up across all of these companies. So if you want to be at the center of this universe, you have to be willing to go where Elon goes. And as we know, he not only has these 6 companies, but he's doing a million other things as well. And so whether they like it or not, I'm not sure if it really matters, because that's just what it takes to work for Elon Musk.
And Kurt, the center of it all, as you mentioned, from an economic financial perspective, is Tesla. Stock's off 28% year to date. Is that exerting any pressure on Muskonomy?
Well, it is, because we've started to hear rumblings that Tesla's board is, unhappy with Elon being distracted with these other companies, right? And so I think when things are going well, when the stock is up, when business is booming, the idea of him spending, several hours a day over at Twitter or now X is not as big of a deal, right? But when suddenly the stock is down, when business is struggling, those hours feel like a huge distraction, and it feels like he's not plugged into the money-making part of this machine, which is Tesla. And so I think the business there is a huge indicator of what he's able to do with his time elsewhere. And that's what we're seeing right now. I think that tension as Tesla's business is struggling is creating pressure on him to focus more of his time at the car maker.
How do all the businesses, though, intersect? Because from a broad look, they don't. But then if you dive a little deeper, like they do. Like X, you can use all that stuff for large language models for his AI stuff. And the AI stuff goes into the car stuff. And the car stuff, I guess, goes into the rocket ship stuff.
Yeah, I mean, you kind of hit on it. Like the connective tissue between these companies can be somewhat small. In X's case, as you pointed out, the data there is being used to train a chatbot called Grok within XAI. We know that, for example, the corporate plane, like small things, the corporate plane that Elon uses at Tesla is the same one that's used at SpaceX. We know that they share certain employees. So, I mentioned Gerard Hart, his business manager, Alix, his lawyer. Like, these are the types of connective things that bring these companies together, is the people and sort of, the smaller parts of their business that are intertwined. And I feel like, again, I already talked about it, but Tesla is sort of the engine behind this whole thing. If Tesla is humming and doing well, it kind of enables everything else to grow too.
How about Twitter? You bought that for $44 billion, Kurt, and a lot of analysts says the value of Twitter's declined dramatically as advertisers have fled. Is there any pushback from anybody, or are folks just saying, hey, it was his money, he can do with it what he wants?
Yeah, I mean, I do think it poses a challenge because of this distraction I was talking about with Elon's time, right? I think especially if you're a Tesla investor, you have to be scratching your head and saying, what are you doing? Why are you spending money on this spending time on this money losing business when you could be sort of, making money for shareholders over here. And I think it's, becoming a bit of a problem. I think what will be interesting is to see whether X sort of gets folded into XAI at some point. Mm-hmm. I could see those two companies sort of merging so that, again, X provides the data for these large language models, but it sort of gives him some cover to spend time at X because now it's part of the AI business, which is much more exciting, I think, for people than the free speech business, which hasn't been very lucrative for him.
The free speech business. Who's in the free speech business? Like, right. What is that? A bunch of lawyers.
That is Elon. Elon is in the free speech business, I guess.
So what do you think the biggest question then is in your reporting? What emerged as the biggest problem or the biggest question?
Yeah, I think really it comes down to kind of this. I haven't really talked much about this yet, but Elon's pay package at Tesla is sort of up for debate, right? You may remember he was supposed to be paid, I believe it was $56 billion. And that pay package was, I believe, set up in 2018. It's been challenged in court, and a judge basically said, this isn't a fair, compensation. And Elon is fighting this in court, but it's a huge deal, not only because it's, his own net worth, but because that money is then used to fund so many of these other projects. So if he's not able to secure this pay package that he thought he had, it impacts the loans that he takes out. It impacts his liquidity to be able to use on these other companies. And I do wonder if he starts to lose a lot of his net worth, his value, if that's going to have an impact on XAI, Twitter, SpaceX, and others.
All right. Thanks so much, Kurt. We really appreciate it. It's a great read, you guys. You should definitely check it out. Kurt Wagner, Bloomberg Tech Reporter, standing by there for us.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Let's check in on these markets. Again, a little bit of a sell-off here today. Anna Rathbun joins us. She is the Chief Investment Officer, CBIZ Investment Advisory Services, joining us from Cleveland, Ohio via Zoom here. Anna, it seems like we've kind of cycled through these earnings, although we've got some retailers this week. The earnings framework seems pretty solid out there for the market. I think we've got a Fed that's going to be on the margin cutting rates going forward. Does that set us up for a pretty constructive outlook here for risk assets? How do you guys think about it?
Well, good morning. The valuations are still high. I mean, from an entry point, it isn't that attractive. I mean, it's been exciting. And if you've been holding stocks, it has been exciting. But if you're trying to put cash to work, it is kind of a nervous environment. So earnings, great. It's about 6% year over year. Guidance, not so great. And underlying that guidance really is the economic activity. The GDP number came in this morning. Forget the first quarter, because if we want to compare it to earnings, which is year over year, you have to compare the GDP year over year. And that number is 2.9%. Better than 1.3, but 2.9% GDP growth to 6% earnings growth year over year. That basically tells you the stock market isn't the economy. But that is the economic backdrop, and those are the fundamentals that the companies have to work with. So poor guidance, weaker growth prospects, these don't really excite us at this point, especially when the valuations are high.
You had Bill Dudley writing a column for Bloomberg today that it was fun. It was talking about the neutral rate. Maybe the neutral rate is a lot higher, so it's not sort of higher for longer. It's higher like forever. We're going to be in a totally different kind of normalized environment. What do you think about that?
Well, so I do think that neutral rate is probably higher. It doesn't mean that the rate right now isn't restrictive enough, right? So right now, I do think that it is restrictive because the rate sensitive areas of the economy and the markets, they have responded. It's the not so rate sensitive areas that have been really booming. If you think about the 66% of Americans that own homes, most of which, grand majority of which have locked in low rates, that's not rate sensitive, right? So, and 34% of Americans who are renting, their rents are super high because there aren't that many homes out there for them to buy. So the rent keeps going up. So from that perspective, the majority of Americans actually are not rate sensitive, right? So to me, raising rates from this point on or keeping rates super high for indefinitely isn't really going to help us with the inflation, bringing inflation down to what I think is an arbitrary 2%, because it's not going to affect those people who have low rates, right? So I think thinking about where the neutral rate might be, which by the way, nobody really knows, and thinking that the err on the side of higher forever or higher indefinitely, I think is a little bit too restrictive. I do think that we need to be on the path for normalization.
So Anna, given that backdrop, it sounds a little bit more of a conservative bent for you. Kind of, how are you guys thinking about asset allocation these days? A little bit more defensive?
Yeah, I mean, so we're long-term investors and we're diversified investors. And for a lot of us, it hasn't been easy for a while now, for about 2 years. Stocks and bonds have not been correlated. I mean, they have been highly correlated, maybe not today because of tech, but the correlation has been really high. And in that environment, diversified portfolios are really difficult to manage. So a lot of our investors have gone into alternative investments. So here we're talking about absolute return type of strategies like hedge funds. Hedge funds run the gamut, so you really have to be not careful, but very selective in what you choose, and certainly managers matter. And a lot of people have gone into private credit and private equity, but I will remind people that despite the fact that you don't experience that day-to-day, intraday volatility in those instruments because they're not marked to market more frequently, as frequently as the public markets, the underlying exposure to the economy is exactly the same. So you're either going to feel it now or you're going to feel it later. So you really have to be choosy, but certainly diversifying away from stocks and bonds, we've seen a lot of that happening.
What should your allocation be to bonds? The narrative of the last couple of days is higher rates hurting stocks, and then today it's like, okay, maybe we've seen the run up in yields, go ahead and buy some bonds, but stocks are still trading heavy. What do you make of all of that?
Yeah, so if you're investing in bonds, certainly bonds, if you lose bonds and stocks are going to lose more, right? I mean, it's just a more volatile asset class, and it's lower in the cap stack, right? If you own bonds, yes, we're in a very difficult environment, but you have to own it for income. If you own it for total return, or if you own it and you're price sensitive, it's not going to be a fun ride for you, right? So if you're owning it for income, and if, let's say, credit, for example, investment grade credit, spreads are super tight, but underneath that, the total income is very high because underneath that, the risk-free rate is very high. That's the treasury rate. So if you own it for income, then I think it could be lucrative for you if you're owning it for income. Now with stocks, earlier I said valuations are high. Stocks are irrational. You're gonna encounter irrationality in the markets. The best practice here really is to rebalance regularly. So you're taking advantage of the irrationality of the stock market when it goes up. Take the gains and rebalance your portfolio. And if you have that discipline over the long run, you can have much better risk-adjusted returns.
So, you know, a lot of folks are kind of feeling like if they're long tech, they're in a good place because tech's going to lead this market. Do you share that view, or do you feel like you need to be more diversified in equities?
Well, we're very diversified, but we do have exposure to tech. I think that tech is exciting. I mean, there's a little bit of push toward AI and an AI exuberance, and a little bit of it being punished today. But I think AI is a real deal. Right now, we have proof of concept. We have to see how it actually manifests itself in different areas of the economy. We're not there yet, but it is going to be a real deal. And a lot of these companies, especially in the S&P 500, large companies, they're not betting the farm on AI. They have an actual business with a lot of cash flow and, frankly, very little debt. So when they're actually incubating AI and see how they can be incorporated into the rest of the business, I think that it is actually a worthy venture. And if you're a long-term investor, it actually will pay off to hold on to tech.
All right. Thank you so much. We really appreciate it, Anna. Thank you, Anna Rathbun, CIO of CBIZ Investment Advisory Services, giving us her perspective on the market. I do not envy being a money manager at this time.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.